Hi, everyone, and welcome to AB Conversations, where we will help you CFP your way out of it. A podcast where you get into the minds of a couple certified financial planners on how we think and feel about everyday financial planning questions and what should really matter most to you. A healthier financial life starts now.
Hey there, Ben. Welcome back.
Hello, Adam. How are you today?
Fantastic. Finally warm out.
Yes, I'm sweating, and it's
Wow.
not because I'm scared to talk about this topic. It is warm in here, you know.
Yeah. So
We'll
let's
take it.
let's get in, get out. Nobody gets hurt. Get the air conditioner back running.
Yeah, these old buildings. It's a fact.
Yeah. So topic today is investments, and a specific question that I feel
Woohoo!
that we've been fielding a fair amount recently. Stock market hitting all-time highs with fair regularity so far this year. We've
26
seen
times. Did I read that right?
Is that what it is?
27 times.
Yeah, we've had a little bit of a pullback here in the last couple of weeks. But still, we're still within, a few percentage points of, hitting all-time highs again. And
Yep.
Typically all-time highs beget more all-time highs. But the question we've been getting is, for those that are either in cash or starting out with investing, is now still an okay time to invest while things are at all-time high, or should I wait?
A very, very fair question that we have a pretty confident answer to, I'll say.
Yeah.
Right. Again,
Yep.
Not the reason I'm sweating. Let's maybe put some context to why we say we have a kind of a confident response. We've certainly experienced it, and I'll say we typically have a more conservative client base.
Mhm.
So I think it's very true for our clients, but statistics show, behavioral finance shows that people are 2.5 times more worried about loss than they are about the prospect of gain. Right.
Yeah.
So I think that fits right into this, where if you see it's at all-time highs and you're worried about loss more than you are future gain, that
Right.
you're maybe thinking to yourself, oh, man, this maybe just isn't a good time. And it's also, I think, just how we operate with some recency bias, right? If I
Mhm.
flip a coin, 10 times and the last 5 times were heads, and I ask you to call the next one, you might go, well, it's been heads a lot. Maybe I ought to pick
Mhm.
tails. And again, statistically, that may not be the way that it should work out.
Right.
Right. The series of events may not be, completely, it's certainly not predictable.
Right.
But I think it's just how our minds work. So it truly is a fair question.
Yeah, absolutely. And so there was an article recently published by JP Morgan with a little bit of research to kind of back up why they say, and we would agree, that as long as you have a long-term outlook, right? Long-term being more than a year or more than 2 years, right?
Yes, key. Yep. That's
key. Not short-term, long-term outlook, that if you are looking to start investing, now is almost always the right time. And here was the data that they used to back it up. They started with they went back to 1988. Why 1988? Because something happened in 1987 where one day the market was down 22%. They had to exclude that from the sample size. But picking any random day going back to 1988, if you started investing on that random day, 1 year later, your return on average was 11.9%. This is using the S&P 500.
Yeah, that's remarkable.
So pick a random day, 1 year later, on average, you're up almost 12%. That's great. Then they used same kind of idea going back to 1988 and only started investing on days that the market hit an all-time high. Again, the market here being the S&P 500. And your 1 year return later was 14.3%. So completely, debunks the thought of it.
It like doesn't compute. Like, how can that be?
Well, that's this is where what I said earlier, like all-time highs beget more all-time highs. As you're making highs, the market is trending higher, and those highs can continually happen in any given year, to your point where we are 26 all-time highs this year alone. That can happen. So their argument being, extrapolating that out over 3-year periods, 5-year periods, the the data still aligned to the point where
Yep.
if it's a random day or you're picking a time at all-time highs, it should be irrelevant. As long as your time horizon is appropriately long-term, as
Yep.
we would almost always invest for people with that long-term outlook, then if you're starting or putting cash to work, now is probably still an okay time.
Yeah.
Fun.
That's just remarkable to me. So let's also then go back to some of the fundamentals that we would also talk about on that data aside. When people talk about the market, right, they're usually talking about the S&P 500. The other reason we would say, hey, don't get too caught up on the all-time high is you're probably going to diversify your investments. That's across not just one market, but many. And many of those others may not be quote unquote at their all-time highs. So
that's a good
if
point.
you're going to spread it around enough, you're still not trying to time that one thing.
Yeah.
And I guess I should take that one step further. If it's a chunk of money, like if somebody is now saying, hey, I came into something, again, recent conversations, I sold a property, I inherited some money. Hey, it was bonus time at the end of the year. Do I put this money to work? It's okay to think in terms of dollar cost averaging, right? Just dividing that pool of money by some interval of time that you'd be comfortable kind of just putting it in, where you're not trying to time things today at the all-time high, but over the course of a couple months, if that makes you feel better. But the point is to not just wait for some sort of massive pullback, because that's where people get caught.
Yeah, the idea behind dollar cost averaging is that, to your point, it's you're spreading out the timing risk over whatever that time period is, right? And I think to us, it depends on the size of the investment, right? We may split it into two pieces. We may spread it out over 3 months. You can spread it out however long you want, right? 6 months, a year, depending on the dollar amount. But the idea there is you're taking equal parts and investing. Let's say it's June 1st, you're going to put a third to work, and then July 1st, you're going to put the second third to work, second third to work, and then August 1st, August 1st, you're going to put that last third, and you're removing your emotions from the timing side of things. This is the plan. We're going to invest on these dates. It's like investing in your 401k out of your paycheck,
exactly.
Right? You don't think of the timing. It's when it comes out, it gets invested, and whatever the price is at that time, you're buying it.
Yeah, and that's not to take away from, look, if you're dollar cost averaging, we have clients that we know have some cash, or they build cash either through their savings or it's quarterly bonus, whatever it is. There certainly are times where we would say, maybe against their emotions, hey, guess what? Great news, the market's down. I don't know why. I still don't know why the market is the thing that people don't like to buy on sale. Everything else in life, like we kind of look at it that way. If you are in some sort of dollar cost averaging, you have some sort of systematic payment, it is kind of okay on those pullbacks, which happen pretty frequently. The market is choppy and it does move quickly, to use that as another impetus to get in. So it's kind of the reverse of what we're talking about. Hey, all-time highs, I don't want to put money in. Well, don't worry if it's at an high. Don't worry if it's at a low. These are all buying opportunities.
Yeah, and ultimately, I think that may be the key takeaway here, right? The timing, don't get in your own way. Yes, you can certainly put a chunk of money to work, and the market can go down 5% the next day. That certainly can happen. But if you are looking at it again, going back to the long-term time horizon, you go out a year, 2 years, 10 years, 20 years, right? If you're investing for long periods of time, that one day is a little blip on hopefully the graph being sloped upwards and to the right.
Yeah, and I think we're bringing this to light because if you feel like you have been burned before, either by timing or by some investment, again, statistics show you are significantly more likely to not want to invest, right? And by the same token, it's very easy to find a naysayer at any given time, right? You don't have to be a Google expert. You put in, should I invest right now? And you're going to get a bunch of articles, right? Look, if you are looking for reasons not to invest, you're going to find many, which is why we're kind of just sharing these statistics, sharing the fundamentals.
There was a great quote. LPL actually shared this a few months ago. And I actually had to look this guy up because I never saw the name before, but his name was Jesse Livermore. And apparently he was a stock investor. He was born in 1877, right? So he was an investor in the early 1900s.
All right.
Right. back when stock trading was stock trading.
Yeah.
So he is considered the pioneer of day trading, right? Not something that we would necessarily condone or, kind of say, hey, go trade on a daily basis and try to time the market. But his quote, and I'll read it here. It says, "One of the most helpful things that anybody can learn is to give up trying to catch the last eighth or the first. These are the two most expensive eights in the world," right? The point being,
timing.
everybody would love to be able to sell exactly at the market peak and then be able to get back in exactly at the bottom and be able to time things perfectly. His point being that's impossible. So focus on everything in the middle, right? Just if you are, again, a long-term investor, we've said this before, it's time in the market, not timing the market. Let the factors at play here, and especially when it comes to time can be your best weapon. Don't twist yourself in knots trying to pick the perfect day to buy.
Yeah, and
Just do it.
And get out of your own way. I guess that's maybe the simplest way to kind of articulate what we want to get across on this specific topic, right? You can find reasons not to do it. It's okay to worry, but it almost has to be that whole set it and forget it, especially if it's not short-term money, right? It's the same way we talk about allocating retirement dollars.
Mm-hmm.
Like if you have enough of a reserve, you give yourself permission to go through those difficult times. So if it happens to be the day that you invest was the all-time high, and then we go through one of those 5% market pullbacks or a 10% correction, as long as you have a long enough time horizon, like again, it will come back up. And I want people to kind of remember the last couple times that the market felt rocky. It's easy to talk about the pandemic, but it was 2018 with some Federal Reserve surprises and trade tensions with China and policy, back to 2015, oil, like there were many different reasons why the market does have those hiccups. But in every one of those cases, going back these last 7-8 years, they were quick. These moves were quick. So you almost do have to give yourself permission to wait it out and not worry about, in your point there, that first eight.
Yeah. So on that note, I think you kind of alluded to it earlier, and now even just talking about kind of all of those points in the last couple of years that felt significant, but they were quick and things kind of rebounded quickly. When it comes to like the headline news, which right now, right, feeling like you're investing at all-time highs, it's the media's job to sensationalize and try to get eyeballs. Now I'm thinking back to earlier this year, which doesn't even feel like this happened in 2021, but the meme stock craze, right? Reddit, GameStop, just the headlines that were being thrown out there to catch eyeballs. And it truly, now this is quite the opposite of trying to time things, right? Of feeling like you don't want to invest because things are at all-time highs. This was quite the opposite. This was people chasing that performance because it was all over the news, and it was the fear of missing out, not the fear of a crash. It was, let me just pile onto this bandwagon. And again,
am I missing out on crypto?
I don't even know if we're allowed to say that.
Are we missing out on
it's fine.
Alternative to current?
That's a compliance thing for everybody listening. We're not allowed to give specific advice. We're not allowed to even mention certain words. No, I know.
I'm referencing it was a craze that was in the headlines, and as of, I don't know when people are going to watch this podcast. As of this week, it's like really back in the headlines.
It's down 25-30% this week.
We're sensationalizing that.
Yeah. So I guess the point there being the opposite feeling, and I think a lot of it does have to do with just the access to information now, right? It's at your fingertips, literally. And it's the juxtaposition between, the fear of missing out on gains versus the other side of like fear of losing what I've already earned and what I've already saved. And I think what we see there sometimes is the disconnect between Oh, I'm now thinking like planning as a whole, stripping out
Okay.
the investments, the fear of, a couple percent volatility in the stock market. Meanwhile, someone's coming to us and they may not have, a cash reserve. They may not have insurance set up. They may be focused on all of the things that may be minor risks, and to what we
Yes.
would see would be major risks to their financial life, not just the investment side of things.
Yeah, so I don't want to butcher this either, but this was not too long ago that I saw this one, and I think it brings home that point that we're focused on something that doesn't happen even as frequently as we would think, right? So
Yeah.
if you ask the general public, what percentage of the time is the market yearly way down? And this study considered that like worse than 12% for the year, right?
Yeah.
Versus down a little bit, -11 to 0 versus a little up or way up.
Yeah.
Since 1926, I think it was, and I don't remember when this went through, only 7.5% of the time has the market been, by that definition, way down. A little bit down, 19.5. So we're talking like 3/4 of the time the market year over year is up. But we are so focused and so fearful of that negative time that when you asked people how to respond to that, 50% of people thought the market was down essentially every other year.
Yeah.
And that's historically not the way it's been.
Yeah. So how much of that is just media bias, right? The negative being easy to sell versus just the behavioral side, right? What you mentioned earlier, just human nature.
And that's the problem,
to not
Adam.
want to lose. And maybe it's both.
It's both. It is both. And I think that's the problem. And that's why, again, I'm not trying to get flippant now. I hope the point for people is just get the heck out of your own way. Like, that's why we're here. Let's fundamentally go about it with diversification, with dollar cost averaging. I don't want you to be the person that last April or last May went, let's just wait to see things settle down. And then you got to November and it was like, well, let's wait to see what happens with this, election. And then you got to January and you're like, wow, GameStop, these things, the market, the fundamentals of the market are going to be upside down. This is an extreme case, but you have missed out on essentially 100% rate of return recovery since, last March. So let's just take a deep breath, all-time highs. Like, this is just a point in time that, quite frankly, does not matter. And your statistics earlier talked about it.
Yeah. So I think the last point that I would want to make is, and I know we've said this on other podcasts, we believe risk is mostly quantifiable when it comes to investments, right? We use a tool called Riskalyze that we walk through with clients to help put that into perspective, right? The ultimate point for us when investing for other people, or just kind of giving them, the review on what they currently own, is trying to set those guardrails of what statistically is quote unquote normal in any given, investment that they hold. And the crux of it is trying to determine at what point do you, everybody out there, reach a breaking point with your investments where you are seeing that negative drawdown to the point where you can't stomach it anymore and now you have to get out. Because our point is, we would never want you to be invested in a way that you got to that point, and then a March of 2020 happens, you sell out at some point during March because it just doesn't feel good, and now that first decision is made, it's time to get out, but that second decision on when to get back in is ultimately the one that we see screwed up the most, because it's hard to now convince yourself to get back in when things are probably still not looking so good.
Yeah, it is not. I know we've said this before too. Investing's not a coin flip. This is not heads you win, tails you lose, or black, red, however you associate gambling and investing. The point is, quantifiable. Just because you put it in an all-time high and the market maybe then went through a downturn does not mean it's lost forever. And it certainly does not mean that it's all going away. Like, that's not how investing works. Remember, it's a zero-sum game, right?
Yeah, that's absolutely true.
I liked it. I liked this one. I hope it was really helpful for people that maybe got some money on the sidelines. or again, just emotionally, they get kind of tied into knots. It's important to just talk through these things. And yeah, we're going to lean on history and data to kind of help prove some points, but keep it simple.
Yeah, ultimately it's just resetting the expectation, trying to get out of your own way, and being okay that if you finally, make the decision to invest, that it could go down, but keep your time horizon long enough. And more often than not, history has shown the market always goes higher. It just may not be in a straight line.
That's right. Well, it's not going to be in a straight line.
Volatility is the price of admission when it comes to the stock market.
You got it. Very well
All right.
said. Thank you.
See you next time.
I'll be here.
Great. Me too. Bye. See ya.
Hey everyone, Adam and I really appreciate you tuning in. Please note that the opinions we voiced in the show are for general information only and are not intended to provide specific recommendations for any individual. To determine which strategies or investments may be most appropriate for you, consult with your attorney, your accountant, and financial advisor or tax advisor prior to making any decisions or investing. Thanks for listening.